Good morning, everyone, and a very warm welcome to all our guests who have joined us today from across the globe for yet another interesting webinar on real estate trends and opportunities in India. I'm Girish Gupta and I'll be your host today. In our today's session, we'll start with insights on real estate trends and opportunities, followed by a Q&A session, and concluded with a brief presentation on home and mortgage loans. So please stay tuned till the end for some interesting key takeaways and investment insights for making a more informed decision. To share his thoughts on this complex subject, we have with us Mr. Pankaj Kapoor, founder and managing director of Lazarus Forus. Mr. Kapoor is a seasoned real estate data specialist and founder of Lazarus Forus, India's only non-brokerage real estate research and analytics firm. With over 27 years of experience, he is known for his pioneering work in real estate valuation, market analytics, and risk advisory. Under his leadership, Lazarus Forus has built a robust database tracking over 20,000 projects across 60 cities, offering critical insights to banks, housing finance companies, developers, institutional investors, and policymakers. He has introduced path-breaking models such as urban price setting model and magnet theory, which have brought scientific rigor to property pricing and urban growth forecasting. Pankaj sir is a member of Central Advisory Council of RERA. He holds an MBA from Institute of Management Education, Pune, and BSc in Mathematics from Lucknow Christian College. With this brief introduction, over to you, Pankaj sir.
Thank you, Girish, and thank you everyone for joining in. And I'll be taking you through the presentation. So I'm sharing the screen. Yeah, Girish, my screen is visible.
Yes, sir.
Yeah. So thank you once again. And here I'll be talking about the builders market across 75 cities in India. And we are a non-broking realty research company, and we don't do any transactions, and we collect these data. So some of the trends related to real estate market, I'm taking you through. So in regards to the market, if you were to see the total market of across these 66 cities, 60 cities, 60 urban agglomerations or 75 cities have done around 6,54,000 unit sales, valuing 8,27,000 crore. And there was a new supply last year in the range of around 5,22,000 crore. On YOY basis, there was no growth. Actually, there was actually flat market in terms of the sales. Value wise, it has grown by 15%, but new supply dropped by 10%. Overall aspects, the real estate market today contribute around 6.9% of the GDP. Residential contribute 82%, and the retail and commercial contribute around 18% in the market. Top eight agglomerations, which is like MMR, NCR, Pune, Hyderabad, Chennai, Bangalore, Ahmedabad, and Calcutta, contribute around 4% growth on YY basis with 5 lakhs units sales out of 6 lakh 50,000 units. And tier 2 cities contribute, the remaining tier 2 cities contribute around 1 lakh 45,000 units, and there was 12% drop from the last year. And if you see the graph clearly indicates that post 2020, we have been seeing a gradual growth in terms of the sales, especially in the tier 1 cities, and tier 2 cities also grew, but the last 1 year we have seen a flattish growth. So it certainly suggests that the market in terms of the sales is touching the peak. Uh, in regards to the cost segment wise, if you see the market is skewed towards the luxury segment. So the unit costing less than 75 lakhs has shown a decline, with a little exceptions, with the low base unit costing less than 10 lakhs has shown a 29% growth, but unit costing greater than 75 lakhs has shown a higher growth. And as the ticket size has increased, the growth has also shown a higher trajectory. In terms of the value, because the growth has been higher towards the luxury and ultra luxury segment, if you see in terms of the value wise, sales numbers are skewed towards the luxury and ultra luxury segment in terms of the values. New launches have seen a decline by 10% last year, and it has been showing a consistent growth uh, all through the last year, and then there was a decline. Top eight cities or urban agglomeration has shown 4 lakh units amount of the new launches, and the tier 2 cities have shown 1 lakh unit new launches. Top eight cities have shown a decline by 13%, while tier 2 and tier 3 cities have really maintained their own levels. The new launches, since they have declined, so majority till 1 crore segment we have seen a decline, but greater than 1 crore segment we have seen a growth in the new launches, with the higher growth in the 1 to 5%, and then greater than 10%. In terms of the value wise, also the new launches are highly skewed towards the luxury and ultra luxury segment. So this has been a tendencies of the market where the sales has been good in the luxury and ultra luxury segment, and that is what is inducing the developer to launch more and more luxury and ultra luxury segments projects, and that is where the new launches are also skewed towards that. In terms of the inventory, we have seen a decline to the extent of 7%. And today's across these 75 cities, we have 10 lakhs unit unsold stocks, with the tier 1 cities have around 8 lakhs unit unsold, and the tier 2 cities is 1 lakh 61,000 unit unsold. But the unsold doesn't really mean there is a risk in the market, because these unsold is in the different stage of the constructions, and because the builder sells in the under construction, so it's not something like that the people perceive that this is a ready stock and lying unsold. And if you see clearly, the inventory overhang has been across most of the geographies below 24 months, which could be considered as an efficient level of inventory overhang. So most of the cities except for Chennai and Ahmedabad, which is crossing more than 24 months, rest all the cities we are seeing the inventory overhang is very, very efficient level. So it's not a concern, because my volumes of the sales are also in line with the maintaining the inventory overhang, good inventory overhang. So 10 lakh unit is not major cause of concern. And this is also shown, the data is showing, declining trend of the inventory overhang. So there was a time in 2017-18 when the inventory overhang in the major cities in India was touching close to 50 months. It has been dropping since then as the market has really progressed, and today it is holding at 19 months for the top 8 cities and 17 months for the tier 2 cities. In terms of the prices, we have seen that the North Indian cities have shown a more growth in the property prices in the recent times in comparison to the rest of the India. So Noida, Greater Noida, Ghaziabad, Gurgaon, Delhi, Faridabad, these are the one where we see a higher growth in trajectory over last 3 years. And in comparison to the Mumbai, Hyderabad, Ahmedabad, and some other regions where the growth has been more moderate. And this is, and why the North Delhi and NCR has shown a higher growth in the prices is more to do with the limited available supply in the market, because a lot of supply was stuck because of the past delays, and the new launches has been comparatively much lower in comparison to the other cities. So with the limited supply, the builder had the opportunity to increase the prices, and this is one market which is also highly investor driven. So unless until the price growth really triggers off in the Delhi NCR market, we don't see investor participations in the volumes coming back. So that is why we see a higher price growth in the Delhi and NCR regions. So these 20,000 projects which we are covering, we have seen 63% projects have shown a growth between 0 to 10%. with around 18% projects have shown a growth of greater than 10% of the prices, and there are around 19% projects have shown a decline in the prices. So it's not that everywhere every project is showing a price growth, and the price growth also has been moderate. So unlike the, and this is based on the change in the prices at the project level. So it's clearly indicating that the market is maintaining its efficiencies. Most of the geographies are not in the speculative mode, and the price rise is highly dependent upon supply and demand matrix in that particular micro markets. Market also, as I clearly indicated on quarterly basis, also if you see that post June 2024, we have seen a gradual marginal decline in the sales, which clearly indicating that the in terms of the volume, the market is peaking, and both in the tier 1 and tier 2 cities. But there is a cause of concern also, which I wanted to lay down, like, as the graph is indicating, this is a two lines. One, the green line shows that the available marketable supply in the market, which is being launched by the developer and in the different stage of construction, which could be primarily under construction supply, and the red curve is suggesting the constructed proportion of the marketable supply. So clearly indicating that the market used to maintain 65 to 70% of the marketable supply. The ratio to the constructed supply to the marketable supply used to be 65 to 70%, which post 2021 we have seen a growth in the marketable supply, but the constructed supply is not growing, which clearly indicating that there can be execution default by the developer. So one has to be little careful in terms of choosing the projects and the developer, because we are seeing increasing probabilities of the default in the executions of the projects. So that is something, and this has been obvious in most of the cities. With the MMR, if you look at the peak, which reached to 2021 is 68, has come down to 49, NCR 48, Bangalore 45%, Hyderabad 56%. So in most of the geography, the ratio to the constructed supply to the marketable supply has been showing a decline, and which is a cause of concern. And in order to find out that which are the major geographies where the investment is taking place and they have a growth trajectory when it comes to the real estate development and economic development, we carried out a ranking model where we have taken two axes of assessment. One axis was where we analyzed the infrastructure, economy, and investment growth, and the other side we have looked at the real estate dynamics growth, in which we have considered supply, size, rental, and price. And this is a module where we have looked at, as I mentioned, there are two axes. One axis talks about economic growth potentials in infrastructure development, current investments, population density, which are actually guidance for cities' economic growth and growth driver. And another side is real estate supply, price, and rental, which talks about real estate dynamics. And these are the weights which we gave it. So we gave higher weights to the investments. We have given higher weights to the metro and urban transits. We have given higher weights to the population densities. In this particular, when it comes to the economic infrastructure and investment, and we have also given higher growth in terms of the supply size, 3-year CAGR growth, and the rental yield. Why we consider rental yield? Because it shows the price productivity, because most of the people, they put in the money for the investment. So the likely chances the property appreciation is highly linked to the prevailing rental yield, which we call it, is suggesting the productivity of prices in the properties. So if the rental yield goes low, and too low, which is like below 2%. That means the capital value appreciation has been higher and rental has not appreciated. So in that case, the prices are not productive. So the growth trajectory for the prices will be having downside pressure, or they may be stagnancy. And if the rental yield is higher, that means there is the capital values are moderately going up, and clearly indicating there is a better price productivity in the market. So that is how we did this ranking. So this is how the tier one cities stands up, where in terms of the real estate dynamics and economic infrastructure investment point of view, the top ranking is Mumbai, then the cluster of Hyderabad and Bangalore, and then in terms of economic and infrastructure wise, Chennai and Delhi has a higher, but real estate dynamics, because the supply size is still moderate and rental yield is low. Delhi and Chennai is still hovering down. Ahmedabad, Pune, and Calcutta is holding in one another cluster. And this is my tier two cities, in which the Surat stands in the highest growth trajectory, both in terms of the supply side dynamics as well as economic and infrastructure point of view. So this is how it is ranked: Surat, followed by Navi Mumbai, Pimpri Chinchwad, Thane, Gurgaon, Noida, Jaipur, Indore, Nagpur, and Vadodara. These are the few cities where the ranking has shown in terms of the growth trajectory. And cumulatively, if you look at that, is still the Mumbai stands tall, and the clusters and in the tier two cities also we have seen a growth trajectory. But having said that, one cannot take a call when it comes to the real estate investment based on the city's growth. It is highly local subject, so different micro market really behaves differently. So one has to take more cautious approach. Don't go by completely city's growth trajectory, and based on that do the investments. In terms of the city's perspective, look at Mumbai is the largest real estate market in India, which has around 2,228 projects, 1,500 developers, marketable supplies 1,20,000 units. Annual sales is around 47,000 units. Unsold is 76,000 unit. Annual sales value is 1,28,000, and rental yield is 3.34%. So anywhere where the rental yield is greater than 3% clearly indicates the price is productive. There's no downside risk in the property prices. AQI, although reflected AQI is very different. We have taken government data, and which clearly indicate this is still good and better, but the ground realities are different. So this is 110, and this indicates that why Mumbai is ranked higher, where the road and expressway investments are higher, and investments are higher. Population density also is on the higher side, so the scores are higher. And when it comes to the real estate supply score, three and the rental yield, in both the aspects, it scores higher. So the maximum scale is 5. So it has consider got 3.16 against the 5 score, and 3.94 against the 5 score. And we have taken a Euclidean distance rather than taking a product or average of it. So it gets 5.1, which is just a relative index. Doesn't really, the value doesn't indicate anything. In terms of the growth point of view, YY growth is 3.2%, Q on Q is 0.8%, last 3 years CAGR is 3.6%. So, this is one market which has been showing moderate price growth, and largely because the supply size is higher, and this is also becoming more convenience. So, in metro connectivity is actually easing up to the peripheral regions. So the city center is is becoming less competitive in comparison to the improvement in the peripheral regions, which is happening due to the infrastructure, and that is where the price growth is moderate. And one more thing is that after the RERA implementations, you would always find that you won't get the price growth what we saw during 2006 to 2014-15 period, and largely because the RERA has mandated developer to adhere with the construction timeline. They have to so they have to maintain a certain sales velocity, and then they can't speculate on the prices in that manner. So in most of the city where the supply size is good, because of the RERA adherence, we have seen a lesser growth in the property prices because builder have to maintain a certain sales velocity to meet their cash flow requirement, and the market is very efficient. These are the top locations of Mumbai where you have different ticket size point of view. The top three locations we have given. I think the presentation could be shared to the people and they can make use of it later. And I'm not going to every single location. So these are the different ticket size, less than 1 crore, 1 to 2 crore, 2 to 5 crore, and 5 to 10, and above 10 crore locations. Top three locations where the annual sales and supply both are higher, and they could be considered for the investments depending upon ticket size. Second is ranked is Hyderabad, which also has around 3.19% rental yield. And this is also a emerging market, both in terms of the commercial and residential. And it has been doing good. Kokapet, Neopolis is one of the regions where we have seen a lot of supply coming in, and by reputed developer and large layouts which are available. And this has been showing a consistent growth post the formations of the Telangana. The city has been showing growth both in terms of the supply and the prices. Also, and the rental yield is also 3.19%. So that is available. It ranked 3.9 in regards to this. So I think because of the logistic and infrastructure, industrial in infra puts in higher rank, and then investments also higher. So because of that, the rank is higher. And then apart from that, the real estate dynamics point of view, it attains 3 out of 5. So so this is the second market. And the last 3 year CAGR growth is 3.4%, YOY is 2.1%, and the Q on Q is 0.4%. And one thing which we have seen, the from 2020 to 2024, we have seen the steeper rise in the property prices in Hyderabad, but post 2024, we have seen a moderation in property prices. So that's a basic reason we have seen a moderate YOY growth in this in Hyderabad markets. These are some of the cities, some of the locations, depending upon the ticket size, which are available. And these are the top three locations in terms of the sales and supply for the ticket size of the units available in that. Third is Bangalore, which also has around 3.44% with the AQI 95, and sales and supply both are good, and it has a very conducive inventory overhang, and annual sales is around 35,000 units. And it ranks higher both for the logistic and industrial infra, and airport, aviations, metro transits, investments, and population density. On the real estate scores also, supply size attains 3, 3-year CAGR price growth is 2 point, which is moderate, and rental yield is 3.41 scoring, which is good. And because of the higher rental yield, it has been showing a higher CAGR growth, so 6.9% of the CAGR growth and 6.5 on the YY basis. So Bangalore is certainly showing higher percentage growth in terms of the prices. And these are the major locations where different ticket size uh, are available, and then this is again based on the annual sales and supply. Ahmedabad is the one where you are getting the highest rental yield is 4.34%, but alone a rental yield doesn't really signifies because it is good for investments in the sense that the price is productive, but the city is efficient, and the size is relatively lesser than Bangalore, Hyderabad, and Mumbai and Pune, and that's a basic reason it's ranked fourth. So if you look at the scoring point of view, airport and aviation's point of view, it scores 3.75, and logistic and industrial infra 2.75. Rental yields, it scores the highest. And 3-year CAGR is 4%, and YOY basis 3.97%, and Q on Q 1.2%. These are the different locations. Pune is also the second highest in terms of the supply and sales in the top cities across India, and largely because its vicinity to Mumbai, and then the industrial as well as IT growth has been quite good, and but now we are seeing there is a little bit of moderation for the last 2 quarters. We have seen the sales and supply have seen a hit, so there is a declining curve which has started. But so far, it has been second largest grocer in terms of the sales and supply in the market, and its ranking is highly because of the airport, aviations, investments, and rental yield is. So one thing which is very, very obvious across most of the geography across India is first time in many years we are seeing rental yield touching above 3% in India. Most of the time it used to be much lower. And that's a basic reason I am suggesting that there's no price correction risk which is in the market. There's a price productivity, and maybe the prices may not appreciate like 15% and 20% on the YOY basis, but you would find the inflation adjusted growth in the property prices. And there would be a rental is suggesting a growth in the property prices, and so as the infrastructure development is also helping connect improvement of the peripheral regions or the less convenient locations. So that is something which is, so the CAGR growth in the prices is around 4.7%, YOY 3.4%. These are the major locations depending upon the ticket size of the property. Chennai, to some extent, has started coming back after a prolonged stagnancy, and then so once upon a time, Chennai used to be among the top three cities in India when it comes to the real estate sales and supply, which lost its own, potential for some time, and other cities have taken up, but it started showing a growth. So this is Chennai, and here we have 2.7% last 3 years CAGR growth, YOY 3.2%, and Q-on-Q 0.6%. These are the major cities. And the last among the top 8 cities is Calcutta. And Calcutta is coming in terms. So we are seeing a continuous growth when it comes to the Calcutta, and it started being a major contributor of real estate. Once upon a time, the Calcutta used to be having lesser than some of the tier 2, tier 3 cities real estate supply. But today there are 552 developers projects and 453 active developers, and the supply and sales both are growing, and rental yield is also quite good. So it ranks this thing, but comparatively among the top 8 cities is still stands at the last rung. So last 3 year CAGR is 4.6%, YOY growth is 2.8, and Q-on-Q 0.7%. These are the major cities based depending upon a ticket size for the sales and supply availability of that ticket size. Delhi per se does not include the other part of the NCR like Gurgaon, Noida, Ghaziabad has been separated, but within Delhi we have a limited builders activities with only 30 projects and 23 developers, and rental yield is also lower because in North India market, because the capital value appreciation because of some bit of speculations goes too high. So you don't get a rental yield above 3% in most of the geography. So it ranks lowest because of the lesser amount of real estate activities. Because of the restriction, DDA doesn't allow builders activities in Delhi. So CAGR growth is 6.8%, YOY is 4.9%, Q-on-Q is 0.8%. Among the tier 2 cities, Surat stands the highest with the 4.46% of rental yield. Sales supply both are higher, and it has metro urban transits investment score is higher, and then your real estate dynamics also score is higher, and it has shown 4.2% CAGR growth, 2.3% YOY growth of prices. These are the locations where the different ticket size can be procured. Second in the tier 2 city is Navi Mumbai, where we have 3.64% of rental yield. And this is also seeing very huge infrastructure connectivities. The Trans Harbour has been a major booster, which has connected Greater Mumbai to Navi Mumbai, and then the airport is also coming. So this is one region where you have a very huge potentials, and lot of supply is going in this particular direction. So both from the real estate angle and economic and infrastructure angle, it's on the higher curve. And it has shown 4.8% of CAGR growth and 1.3%. So the Q-on-Q and YOY is 4.2%. These are the different geographies. Pimpri Chinchwad, which is annexed to Pune, also showing a third rank, and because of the rental yield and supply size, and because of the high real estate activities, we are showing higher, and its vicinity to Pune itself creates an opportunity of the growth. and it has shown 5.1% of CAGR growth for the last 3 years and 3.6% on YOY and 1% on Q-on-Q growth. These are the locations where different ticket sizes are available. Thane, which is adjoining Greater Mumbai, is also one among the city where we have this stands fourth positions, and this actually occupies the centric position both in terms of the real estate dynamics and economic and infrastructure. Metro connectivity is where the scores are higher, and the real estate dynamics itself is giving a moderate score. So it has shown 4.6% of CAGR growth, 4.4% on YOY, and 1% on Q-on-Q. These are the major locations in Thane. Gurugram, which is actually has been the major market where the luxury housing is being launched. So something very interesting is the average cost of the unsold unit in Gurgaon stands close to 4 crore, which clearly indicates that most of the luxury housing projects is being launched in this particular micro market. And since the rental yield is lower, 3-year CAGR growth in the prices is higher because prices has been jumping up in this market much faster. Supply side is very moderate. We still haven't seen the level of supply it used to have until 2017-18. So this has last 3 years 9.2% of CAGR growth, 6.1% of YOY growth, and 1.7% on Q-on-Q. So that the growth has been highest in when it comes to the prices, and looks like that it is going to continue for some more time because supply side, uh, highly constrained. So if you see less than above 10 crore has the maximum value of his stock sold, and you have quite a substantial size of the project's marketable supply. So between above 2 crore, we have seen majority of the market which is skewed to. Second is the Noida, which has rental yield of 2.86% annual sales and supply. So Noida and Greater Noida has actually seen a maximum contraction when it comes to the supply, largely because a lot of projects really, which this once upon a time it used to maintain close to 1 lakh unit of unsold stock, which has got reduced because a lot of project got stuck, and the new launches has been restricted, so it has limitations when it comes to the sales supply side, and that's a basic reason the prices has been growing up. So this is one market where the price growth has been more than 14%. Last 3 years has been 15% CAGR growth. YY itself is 9% growth. Q on Q is 1.4%. These are the major ticket size wise the locations where the supply and sales distribution are higher. Then comes Jaipur, and which is also one market in the north which has been doing good. So it has a CAGR growth of 7.4%, YY 8.3 and 2.3% of the price growth. These are the different ticket size in which different locations for different ticket size. And then the Indore, although it's new in the news in the recent time, but this was once upon a time touted as the most smart cities, and it has been doing good all through. and it's also showing a price growth of 7.5%. YOY is 5.3, 5.9, and Q on Q 1%. And these are the major locations where the property size. And then we have in Nagpur, where we have seen 3.6% of CAGR growth, 3.3% of YOY, and Q on Q 0.6%. These are the major locations. Vadodara, so 5.1% of CAGR growth, 5.9% of YOY growth, and Q on Q, we have seen a slight decline in the property prices. These are the major locations. So I am done with the presentations and I'm open for any questions.
Thank you, sir, for this insightful presentation. I am sure that this information provides numerous opportunities for our NRIs to gain comprehensive understanding of India's real estate market and opportunities. Now we'll move to a Q&A session where we have received questions from our customers. So our first question is from Mr. Saurabh, who would like to understand and know about Delhi NCR market and YEIDA area.
Yeah, so that's in the Greater Noida along the Yamuna Expressway. So, and we have seen because of the Xavier new airport, lot of activities both in terms of the apartment and the plotted development which is going on. So this has done good, and some of the market like where we have seen certain projects which could be considered for the investment could be Purvanchal, Sunblaze, Aldico, Gorson's runway suits, and there are some of the plotted development which are there, and the plots are being offered at a price band of around 2,300 to 2,400 rupees per square feet. And the apartments are available in the range of around 7,000 to 9,000 rupees per square feet rate. So it is there. But having said that, the development is still to really pick up in this region. This is being one of the reasons which is under a prominence because of the Jewar airport, and a lot of speculative practices also going on because the habitation is still way too low. And Jewar is around 25-30 kilometer away from this, but there has been some of the development which is taking place. And one more point which I actually wanted to speak on, that don't overemphasize the importance of the airport, because if you see the past, the cities where the airport really came up, it doesn't really show a huge growth in the property prices and the habitations, because it is too far away from the city precinct. So the peoples prefer to live closer to their workplace and where they have the social fabric. Most of the times the airport comes too far away. So it is good in terms of narration that airport is coming. So, the future appreciation in the property will be higher. But most of the time it doesn't really take place. So if you take a thin slice of the airport, the surrounding regions of the airport doesn't really show a good urban development other than the hotel and the logistic development which may take place. So one has to be little cautious in that sense, because it is from around 65 kilometer from the city center of Noida. So farther you go, higher it is to live when it comes to the price growth. It is little bit on the speculative ground.
Yeah, thank you, sir. We have next question from Mr. Raghu of UAE. What is the comparative long-term trend in real estate prices for residential, commercial, and farmland?
So I'm saying that the clearly indicating like most of the cities have maintained inflation at price growth of around less than 10%. And I think this is how it is going to maintain. I'm not seeing any price correction risk because inventory overhang and rental yield being in on the conducive level and very, very efficient level. So we'll see a price will continue to be growing, range bounding between 5% to 10% on YOY basis going forward. And different micro market will behave differently depending upon how well their price productivity is and what is the improvement coming in those micro market due to the infrastructure and economic development. So based on that, different micro market within the city will behave and give a different level of returns. But overall aspects, the country in India does not have a fear of price correction risk, especially a very high price correction. There may be a bit of correction of 1%, 2%, 3%. Someone who launches at a higher price and doesn't really attract the velocity may moderate it down going forward. But I'm not seeing any systematic price correction risk because rental yield and inventory overhangs are in a very conducive and efficient level. The price is productive when it comes to India's real estate.
Next question is from Mr. Paranjeet from Saudi. Which Indian metropolis has the best future prospects for investing in real estate for next 10 years horizon?
I think we discussed we did certain modeling, but having said that, if you give different score, different other cities which will emerge. But having said that, in terms of the supply size, population density, and infrastructure development and investments and GDP contributions, Mumbai stands at the top. And that's why even other cities developers are really rallying into Mumbai. And when it comes to the price growth and the speculative market behavior point of view, that Delhi NCR could be considered the second best, or Gurgaon, Noida, and surrounding regions.
Okay, thank you, sir. Mr. Kishore from UAE wants to know, with several new redeveloped buildings coming in Mumbai, will it affect property rates in future?
It clearly suggests that the supply size will continue to be growing, and I'm not seeing any slowdown because recent data, when we analyze the IOD granted for the redevelopment of new projects, the IOD suggests that they are still higher than the last year. So there is no slowdown. So as the supply increases, it will keep prices in check. And that's why Mumbai is showing the least increase in the property prices because supply size is higher. And secondly, is redevelopment is also creating higher density. So my own sense is a lot of redevelopment taking place in the 50,000 rupees plus price bracket, which is luxury and high-end products. With the higher density, it will put a pressure on the prices on the luxury and ultra luxury segment because you have a high cost has to be correlated with the less density, and higher density with the high cost clearly indicate that there would be a lesser desirability for the high end people to continue living in those clusters for the high density. So there are concerns, and it will keep prices in check. You will not see a very, very high price growth in this market. It'll be good for end user, the one who wants to upgrade and move closer, and if they can afford. But for end use point of view, market is good, but not for the investments and short term gain.
We have another question from Mr. Harmanpreet. He is asking what factors mostly strongly influence long-term property appreciation in India? What due diligence check should be never be skipped before buying a property?
So we are developing an investable score of the property where we say that if the rental yield is greater than 3.5%, that means you will see 7.5% of nominal growth in the property prices. And then there are growth driven by the infrastructure development. So the location which used to be taking longer time to commute to the places of the work, if they become more convenient, so the infrastructure driven growth and the prevailing rental yield suggests my current price productivity, so the price growth probabilities are higher. and the improvement due to infrastructure improves my travel time to the location, to the CBDs and the economic hubs. So these two add up to really give a higher invest return probabilities. Apart from that, there are density driven. So there are four factors to the price: distance, density, surrounding, and product. So if your surroundings are sea views, and then there are improvement, and if the density is higher, and so the land prices goes up accordingly, or the probability of density creations in that peripheral region is higher because of the economic and infrastructure development, then the property prices will show a higher growth. But majority of the, if I were to really put up three major reasons, I look at the rental yield, future improvement due to infra, and the density. So if it is very uninhabitable location, it will take longer time for the future infra or social infra development, because you need critical mass for social infra sustainability. So I will look at density, rental yield, and the improvement due to infrastructure to the commutations to the CBDs. Based on that, I'll do the selections for the location.
Great. Thank you once again, Pankaj sir, for sharing your thoughts with us. And now I'll invite Tamanna Pancholia from our ICC mortgage team to give us a brief understanding on how ICC Bank can facilitate and simplify the process of owning a home in India.
Thank you, Girish. Hello, everyone. My name is Tamanna Pancholia. I'm a product manager handling NRI mortgage products at the ICICI Bank. I will take a few minutes to brief you about our mortgage products, loan application stages, and its key features. Beginning with the products, we offer a wide range of mortgage products for our NRI customers, such as home loans for purchase or construction of residential property in India. We also offer loan against existing property in India. Next, we have loan for purchase of office premises or commercial spaces for self-use. Then we have balance transfer of existing mortgage loans with other financiers. Top-up loan can be availed on existing mortgage loans. And lastly, we have the home improvement loans. Coming on to our home loan journey, it involves three stages. First of all, we have the login stage. In this stage, customer can complete their loan application themselves by providing us basic details, uploading KYC and income documents. Next is the sanction stage. In this stage, our credit team evaluates the loan application and takes a decision. Last is the disbursement stage. In this stage, the property documents are submitted, legal and technical evaluation is done, and disbursement formalities can be completed by the applicant or by the power of attorney holder. Now coming on to features, our NRI home loans are designed to be very simple, digital and convenient, with salient features such as online login to sanction journey, disbursement without visiting India through power of attorney, centralized NRI mortgage desk for faster processing, simplified documentation, online post disbursement services, and track my loan facility to check home application status online. I would like to share that customers who are yet to finalize on a residential property can also explore the ICICI Bank approved projects link, which is available on our ICICI Bank website. Here, the customers can search for properties at their preferred location and projects. So to summarize, NRI mortgage loans offered by ICICI Bank are supposed to provide seamless and convenient experience to all its NRI customers. Thank you.
Thanks, Tamanna, for sharing this information with us. Before we take 2-3 questions around this topic, I'll request viewers to share your valuable feedback on the link shown on your screen. Okay, so we have 2 quick questions for Tamanna. One of our customers is asking that I'm an overseas citizen with an OCI card. I don't have Aadhaar card, but I do have a PAN card. I'm wondering if I'm eligible to invest in a property in India.
Okay. So first of all, Aadhaar card is not a mandatory document for NRI or OCI customers. Even Aadhaar or PAN card linking is not mandatory.
Yeah, thanks, Tamanna. One more customer from UAE is asking how to get documents executed while being in UAE.
Okay. So at the time of disbursement, our customer needs to submit attested KYC documents. And attestation of these KYC documents can be done by ICICI Bank branch staff in Dubai or at the Indian Embassy or by public notary. So this is regarding the attestation of KYC documents. But as far as power of attorney is concerned, it can be attested only at the Indian Embassy or by public notary.
Great. With this, we now come to an end. Thank you all for being part of today's discussion and giving your
Thank
valuable
you.
time to us. We hope you found the insights valuable and thought-provoking. We look forward to connecting with you again in upcoming sessions. Until then, please take care, stay safe, and bank on us. Thank you.